The global economy did not collapse, it evolved. There was no crash, no reset, no moment when the old rules officially ended. Instead, the system changed quietly. Growth slowed without stopping, risk increased without panic. Stability replaced opportunity. What looks like normal is a transition. What feels like calm is management. And what many still call recovery is something entirely different. The world is not waiting for the next phase. It is already inside it. For decades, the global economy operated inside a familiar rhythm. Expansion followed contraction. Credit fueled growth. Globalization reduced costs. Central banks smoothed volatility. Each cycle felt different on the surface, but the underlying engine remained the same. That engine is no longer working. The previous phase of the global economy was built on a unique combination of conditions that are now disappearing simultaneously. Cheap capital, expanding labor pools, accelerating globalization, and rising productivity formed a self-reinforcing loop. Growth generated confidence, confidence justified leverage, and leverage amplified expansion. This structure functioned not because it was stable, but because its weaknesses were masked by constant momentum. Interest rates were the primary accelerant. As borrowing costs declined over decades, debt became not only affordable, but essential. Governments financed deficits without immediate consequence. Corporations replaced organic growth with financial engineering. Households expanded consumption ahead of income. This was sustainable only as long as rates continued to fall and confidence remained intact. That trend has reached its limit. Global debt levels now exceed historical norms, not because of mismanagement, but because the system required leverage to function. Each cycle demanded more borrowing to generate the same level of growth. Marginal returns declined. Productivity gains slowed. The system compensated by increasing scale. This is the signature of exhaustion, not collapse. When growth depends on acceleration rather than efficiency, the cycle becomes fragile. Demographics intensified this pressure. The expansion of the global workforce that supported growth for decades is reversing. Aging populations reduce consumption growth and strain public finances. Labor shortages emerge even as demand weakens. This contradiction reflects structural imbalance. The old model assumed a continuously expanding base. That assumption no longer holds. Globalization, once the system's greatest strength, has become a constraint. Supply chains optimized for efficiency proved vulnerable under stress. Geopolitical fragmentation, trade restrictions, and strategic reshoring reduce cost advantages while increasing complexity. The world is not deglobalizing suddenly, it is regionalizing gradually. This shift reduces productivity gains while increasing redundancy. Growth becomes slower but more expensive. Monetary policy reveals the transition clearly. Central banks once responded to downturns with aggressive easing. Today, their flexibility is constrained by inflation, debt, and political pressure. Stimulus no longer produces the same results. Rate cuts support asset prices, but fail to generate broad economic momentum. The transmission mechanism weakens. Policy becomes reactive rather than transformative. Economic data reflects this change. Growth persists, but it is uneven and fragile. Headline indicators obscure underlying stagnation. Productivity gains concentrate in narrow sectors. Asset prices remain elevated despite weakening fundamentals. This divergence is not temporary, it is structural. Markets price continuation, while economies experience compression. Corporate behavior confirms the shift. Capital expenditure focuses on resilience rather than expansion. Supply chain diversification replaces scale optimization. Balance sheet strength becomes a strategic priority. Mergers favor consolidation over innovation. These are not signs of confidence. They are signs of adaptation to a lower growth environment. Labor markets appear strong, but the signal is misleading. Employment remains high while real income growth stagnates. Participation rates lag. Job creation concentrates in services with limited productivity gains. This supports consumption temporarily, but weakens long-term potential. The economy functions, but it does not advance. The old cycle relied on synchronized expansion. Today, synchronization amplifies weakness. When growth slows globally, diversification fails. Regional resilience diminishes. The system loses its ability to offset local downturns. This increases reliance on policy intervention and delays adjustment. Stability is maintained, but progress stalls. Financial markets reflect this tension. Volatility is suppressed, not eliminated. Corrections are shallow but persistent. Recoveries lack conviction. Investors sense support but not opportunity. Risk is present everywhere, but reward is concentrated. This is characteristic of a system transitioning between phases. The most important insight is not that the old model is broken, it is that it has fulfilled its function. It delivered decades of expansion by pulling future growth forward through leverage, integration, and efficiency. What remains is a system operating beyond its natural limits, sustained through management rather than momentum. This transition feels unfamiliar because it lacks drama. There is no singular crisis that signals the end of the old cycle. Instead, there is a gradual loss of effectiveness. Each policy action does less. Each recovery is weaker. Each shock leaves a deeper mark. The system adapts, but it does not reset. Investors often misinterpret this environment as temporary disruption. In reality, it represents a change in regime. The assumptions that defined success in the previous phase no longer apply. Growth is no longer automatic. Stability no longer implies opportunity. Risk is no longer compensated uniformly. The global economy is not slowing down. It is changing character. The rules that govern capital allocation, labor dynamics, and policy effectiveness are evolving. Those who continue to operate under old assumptions will experience persistent disappointment rather than sudden failure. This is how economic phases end, not with collapse, but with irrelevance. The old cycle does not break, it fades. And in its place emerges a system defined not by expansion, but by management. The transition has already begun. One of the most deceptive aspects of the current transition is how little it resembles past turning points. Historically, economic shifts announced themselves through visible disruption. Recessions were sharp. Crises were loud. Markets reacted violently. Today, the signals are muted, delayed, and often contradictory. This is not accidental. It is the result of deliberate design. Modern economic systems are no longer allowed to adjust freely. They are managed continuously. Volatility is treated as a threat rather than a signal. Policymakers intervene not only to stabilize outcomes, but to shape perception. The result is an environment where change unfolds quietly, without the dramatic markers that once alerted participants to regime shifts. Financial markets illustrate this clearly. Asset prices remain elevated even as growth weakens. Corrections occur, but they are shallow and quickly contained. Liquidity appears abundant until it suddenly tightens in specific pockets. These dynamics create confusion. Traditional warning signs fail to trigger action because their impact is softened. Investors wait for confirmation that never arrives. Central banks play a central role in this invisibility. Their communication strategies emphasize calm, flexibility, and readiness. Forward guidance is deliberately ambiguous. Commitments are conditional. This creates optionality for policymakers while discouraging decisive action by market participants. Uncertainty is managed through reassurance rather than resolution. Economic data further obscures the transition. Headline indicators present a mixed picture. Growth persists in nominal terms while real momentum fades. Employment remains high even as productivity stagnates. Inflation moderates in some areas while remaining entrenched in others. These contradictions delay recognition of structural change. The economy appears functional, but directionless. Global coordination reinforces this effect. Major economies respond to stress in similar ways, synchronizing intervention. This reduces volatility, but also suppresses differentiation. When all systems behave alike, relative signals weaken. Investors struggle to identify leading indicators because adjustment is distributed across regions rather than concentrated in one. Corporate behavior adapts to this managed environment. Companies learn that resilience is rewarded more than expansion. They prioritize balance sheet strength, cost control, and pricing power over growth initiatives. Capital expenditure becomes selective. Innovation slows. These shifts occur incrementally, rarely announced explicitly. Markets interpret caution as prudence rather than warning. Households experience the transition as a gradual erosion rather than a shock. Purchasing power declines slowly. Consumption patterns adjust quietly. Savings behavior changes. There is no sudden collapse in living standards, but expectations reset downward over time. This reduces political pressure for dramatic response, allowing managed adjustment to continue. The financial system itself masks stress through complexity. Risk is redistributed through derivatives, structured products, and regulatory frameworks. Losses are absorbed through margins, write-downs, and balance sheet adjustments rather than defaults. This delays visible consequences. Problems are contained, not solved. Media narratives contribute to the illusion. Coverage focuses on short-term fluctuations rather than long-term trends. Each data release is framed as confirmation of recovery or resilience. Structural deterioration receives less attention because it lacks immediacy. The public is conditioned to expect normality punctuated by brief disturbances, not prolonged transition. The invisibility of the shift is further reinforced by comparison bias. Because outcomes are less severe than past crises, they are interpreted as improvement. In reality, they reflect constraint. The system is prevented from correcting fully. This creates stability without progress. Participants mistake this for success. Markets internalize this behavior. Risk-taking becomes conditional. Investors rely on policy support rather than fundamentals. Price discovery weakens. Valuations persist because exits are gradual and alternatives limited. Capital remains invested not because confidence is high, but because withdrawal is complex and costly. This environment rewards patience in appearance, but punishes complacency in reality. Those waiting for clear signals miss the transition. By the time confirmation arrives, adjustment has already progressed. The lack of visible crisis becomes the greatest risk factor. The key insight is that invisibility is not a flaw, it is a feature. Managed systems aim to minimize social and financial disruption by spreading adjustment over time. This reduces immediate pain but increases duration. The transition becomes harder to detect precisely because it is continuous. Economic statistics confirm this pattern. Trend growth declines gradually. Debt ratios stabilize at high levels. Policy intervention becomes permanent. None of these indicators trigger alarm individually. Together, they signal a system operating beyond its natural equilibrium. The invisibility of the transition also explains widespread disagreement among analysts. Traditional frameworks rely on discrete cycles. When cycles blur into phases, interpretation diverges. Some see resilience, others see stagnation. Both are partially correct. The system is resilient in form and stagnant in function. This confusion delays adaptation. Businesses, investors, and governments continue to operate under assumptions that no longer hold. Strategy lags reality. Performance deteriorates quietly. The cost of delay accumulates. The global economy is not hiding its transition. It is disguising it through management. Stability replaces momentum. Control replaces growth. This makes the shift harder to recognize, but more consequential. Those who understand this do not wait for headlines. They observe behavior. They track capital flows, policy patterns, and structural incentives. These signals reveal more than any single data point. The transition feels invisible because it lacks rupture. But absence of rupture does not imply absence of change. It implies that change has been institutionalized. This is the nature of the new phase, and it is already well underway. Managed stability does not remove risk. It redistributes it in ways that are difficult to detect until adjustment is already underway. When markets are continuously supported, traditional signals lose clarity. Price movements no longer reflect conviction. Volatility no longer signals fear. Liquidity no longer indicates confidence. The system functions, but its language changes. One of the most significant distortions appears in price discovery. In earlier phases, prices adjusted quickly to new information. Losses were concentrated and visible. Today, adjustment is fragmented. Support mechanisms interrupt feedback loops. Prices react partially, pause, recover, and drift. This creates the illusion that fundamentals are less relevant, when in reality, they are being overridden temporarily. The correction does not disappear. It is delayed. Policy intervention alters incentives across the system. When downside is repeatedly softened, participants adapt behavior accordingly. Risk-taking persists longer. Weak positions survive. Capital remains allocated where it would otherwise exit. This slows adjustment and increases cumulative imbalance. The system becomes quieter but more fragile beneath the surface. Economic indicators reflect this distortion. Traditional recession signals weaken. Yield curves flatten or invert without triggering immediate contraction. Employment remains strong while output growth slows. Inflation pressures coexist with weak demand. These contradictions paralyze interpretation. Decision makers wait for confirmation that no longer arrives in familiar form. Financial markets respond by compressing time horizons. Short-term performance dominates strategy. Long-term investment becomes harder to justify when structural signals are muted. This reinforces stagnation. Innovation slows not because opportunity disappears, but because uncertainty becomes chronic. Capital prefers safety to ambition. The role of expectations becomes central. Markets no longer trade outcomes, they trade intervention. Price action reflects assumptions about policy response rather than economic trajectory. This creates reflexivity. Policymakers respond to markets, and markets anticipate policymakers. Fundamentals become secondary. Control becomes primary. This feedback loop erodes informational efficiency. Signals that once guided allocation now mislead. Valuations remain elevated despite declining growth potential. Risk premiums fail to compensate adequately. Participants sense imbalance but cannot identify timing. This uncertainty delays action and amplifies eventual adjustment. Institutions adapt by relying less on market signals and more on internal models. Scenario analysis replaces forecasting. Optionality replaces conviction. Balance sheets are structured for endurance rather than optimization. This behavior stabilizes institutions but reduces market dynamism. Liquidity becomes conditional, available only under certain states. Retail participants experience this environment differently. They perceive safety because dramatic collapses are rare. Gradual erosion feels manageable. Losses accumulate slowly. Confidence declines without triggering decisive response. This asymmetry leaves them exposed when conditions finally shift more forcefully. Media interpretation reinforces delay. Coverage emphasizes resilience and recovery narratives. Each intervention is framed as success. Structural weakness lacks immediacy and therefore attention. Public understanding lags reality. By the time concern becomes widespread, adjustment is advanced. The invisibility of transition also affects politics. Gradual deterioration diffuses accountability. There is no single event to blame. Policy choices appear reactive rather than strategic. This allows continuation of the same framework even as effectiveness declines. Change becomes incremental and insufficient. Over time, managed stability alters the nature of crises themselves. Instead of sharp downturns followed by recovery, economies experience prolonged plateaus. Growth remains positive but insufficient. Living standards stagnate. Debt accumulates quietly. Adjustment becomes generational rather than cyclical. This environment creates a false sense of control. Systems appear resilient because they do not break visibly. In reality, they are constrained. Flexibility diminishes. Margins for error shrink. Each intervention buys time but consumes capacity. The system survives, but at increasing cost. For investors and businesses, the danger lies not in sudden collapse, but in misreading signals. Those waiting for traditional warning signs will act too late. The transition does not announce itself. It reveals itself through persistence of mediocrity rather than moments of fear. The new phase rewards those who focus on structure rather than sentiment. Policy behavior, institutional positioning, and capital allocation patterns matter more than headlines. The absence of crisis is not reassurance. It is part of the mechanism. Managed stability delays recognition, but it cannot eliminate reality. Eventually, pressure accumulates beyond what intervention can contain. Adjustment accelerates, not because systems fail, but because belief in management erodes. The global economy is therefore not drifting aimlessly. It is being guided through a narrow corridor between disruption and stagnation. This corridor feels safe, but it is restrictive. Progress slows. Options narrow. Understanding this requires abandoning old frameworks. The question is no longer when the next recession will begin. It is how long the system can sustain controlled adjustment before transition becomes unavoidable. The invisibility of this shift is its most dangerous feature. Not because it hides collapse, but because it delays preparation. Those who adapt early will not appear prescient. They will appear patient. Those who wait for clarity will not fail suddenly. They will simply realize too late that the phase has already changed. Capital always adapts faster than narratives. When an economic system enters a new phase, money does not wait for consensus or confirmation. It responds to incentives, constraints, and probability. The current transition has already rewritten the rules of capital allocation, even though most participants continue to operate as if the old framework still applies. The most important change is the shift in capital priorities. In the previous phase, growth was the primary objective. Investors sought expansion, scale, and momentum. Risk was tolerated because it was rewarded broadly. Today, that logic no longer holds. Capital now prioritizes control, resilience, and access. Return remains important, but it is secondary to survivability and optionality. This shift is visible in institutional behavior. Large investors allocate less capital to speculative growth and more to assets that preserve flexibility under stress. Liquidity becomes a strategic asset rather than a temporary condition. Cash-like instruments, short-term securities, and highly liquid markets gain preference, even when returns are modest. This is not pessimism. It is adaptation to an environment where timing matters more than magnitude. Risk itself is being redefined. In the old cycle, risk was volatility. Fluctuations were dangerous because they threatened near-term performance. In the new phase, risk is rigidity. Assets and strategies that cannot be adjusted quickly become liabilities. Capital avoids commitments that lock it into long horizons without exit. This favors scale, infrastructure, and platforms over single bets. Financial data confirms this reorientation. Investment flows increasingly concentrate in sectors tied to stability and control. Infrastructure, energy security, data networks, and essential services attract capital, despite lower headline growth. These sectors benefit not from expansion, but from indispensability. Their value lies in continuity rather than upside. Equity markets reflect this change unevenly. Broad indices remain elevated, but leadership narrows. A smaller group of firms captures a disproportionate share of returns. These firms often possess pricing power, regulatory advantage, or systemic relevance. Capital gravitates toward entities that can endure policy shifts and economic stress. This concentration is not accidental. It reflects selective confidence rather than broad optimism. Private capital exhibits similar behavior. Venture investment becomes more cautious. Funding favors later-stage companies with proven cash flows rather than early-stage experimentation. Valuations compress, terms tighten, and timelines extend. Innovation persists, but it is filtered through a lens of risk management rather than ambition. Credit markets offer further insight. Lending standards tighten selectively. Access to credit depends increasingly on scale, collateral quality, and strategic importance. Smaller borrowers face higher costs or reduced availability. This does not signal imminent crisis. It signals repricing of access. Capital becomes conditional. Global capital flows reinforce the pattern. Investment favors jurisdictions with predictable regulation, deep markets, and policy credibility. Neutrality becomes less valuable than alignment. Geopolitical considerations influence allocation decisions. Capital seeks environments where rules are stable, even if growth is slower. This reflects preference for certainty over potential. The behavior of central banks amplifies these incentives. Policy frameworks implicitly favor systemically important actors. Liquidity support, regulatory flexibility, and intervention thresholds protect core institutions first. Capital understands this hierarchy. It aligns with protected nodes of the system. This is not conspiracy. It is rational positioning. Market volatility further illustrates the new rules. Spikes are shorter, but persistence increases. Opportunities exist, but they require scale, speed, and information. Retail participation struggles to adapt. Institutional strategies exploit structural features rather than directional bets. Returns accrue to those who understand mechanics rather than sentiment. Another defining feature of the new phase is time compression. Capital demands quicker feedback. Long-duration projects face skepticism unless backed by policy or strategic necessity. Discount rates rise not only financially, but psychologically. Investors require clarity sooner. Uncertainty carries higher cost. This shift reshapes corporate strategy. Firms adjust capital allocation accordingly. Buybacks replace expansion. Dividends signal reliability. Balance sheet strength becomes a competitive advantage. Growth narratives lose power unless supported by demonstrable resilience. Management credibility depends on execution rather than vision. Labor dynamics interact with capital behavior. Talent concentrates in firms with stability and scale. Compensation favors retention over expansion. This reinforces concentration and reduces dynamism. The economy functions, but mobility declines. The cumulative effect is a market that rewards positioning over prediction. Success depends less on anticipating the next boom and more on avoiding fragility. Capital that survives the transition gains disproportionate influence afterward. Those who exhaust resources chasing outdated growth assumptions lose relevance quietly. This is why many participants feel disoriented. Traditional playbooks fail. Risk models underperform. Strategies calibrated for expansion struggle in an environment defined by constraint. The mistake is not poor execution, it is reliance on outdated assumptions. The new rules of capital are not ideological, they are structural. They emerge from a system that has learned to manage stress rather than eliminate it. Capital responds accordingly. It becomes patient, selective, and defensive. This does not mean opportunity disappears. It becomes concentrated. Those aligned with system priorities benefit. Those operating outside them face headwinds. Returns are asymmetrical. The average declines while the aligned outperform. Understanding this distinction is essential. The global economy is not hostile to capital. It is hostile to inflexibility. The new phase does not punish risk. It punishes misalignment. Capital already understands this. Most participants do not. The concentration of capital in the new phase is not a temporary anomaly. It is a structural outcome. When growth becomes constrained and risk is managed rather than absorbed, returns no longer distribute evenly. They accumulate where protection, access, and leverage over systems already exist. This is the defining characteristic of the transition. In previous cycles, expansion created broad participation. Credit growth lifted multiple sectors simultaneously. Rising demand supported wages, consumption, and investment. Even inefficient actors benefited from momentum. That environment no longer exists. Today, capital rewards positioning, not participation. Alignment with system priorities determines outcomes more than innovation or effort alone. The first clear group of beneficiaries is entities that operate close to policy infrastructure. Large financial institutions, systemically important corporations, and regulated monopolies enjoy implicit protection. They benefit from preferential access to liquidity, regulatory flexibility, and policy attention. Capital flows toward these entities not because they are inherently superior, but because their downside is managed. Technology platforms with infrastructural relevance form another category. Firms that control data flows, networks, and essential digital services attract capital despite valuation concerns. Their advantage lies in indispensability. They function as toll collectors within the system. As long as activity continues, they extract value. In an environment where growth is uneven, control over flow matters more than volume. Energy and resource security also gains prominence. Capital reallocates toward assets that ensure continuity rather than expansion. Energy infrastructure, logistics, storage, and critical materials become strategic rather than cyclical investments. Their value increases during transition because scarcity and reliability replace efficiency as priorities. In contrast, sectors dependent on discretionary demand face persistent pressure. Consumer-facing industries experience margin compression as households adjust expectations downward. Pricing power weakens. Volatility increases. Capital withdraws selectively, favoring firms with scale or differentiation while abandoning the rest. This fragmentation reflects the end of broad-based consumption growth. Small and medium enterprises bear disproportionate cost. They lack scale, access, and protection. Credit becomes more expensive. Regulatory burden rises. Market volatility affects them more directly. While they remain essential for employment and innovation, their economic leverage diminishes. This shift is gradual, rarely acknowledged explicitly, but deeply consequential. Labor experiences a similar divergence. High-skilled workers in protected sectors maintain bargaining power. Others face stagnation or insecurity. Employment remains high, but quality deteriorates unevenly. Wage growth concentrates. Mobility declines. The labor market appears resilient, while inequality becomes embedded structurally rather than cyclically. Geographically, capital favors stability over opportunity. Developed markets with predictable institutions attract flows despite lower growth potential. Emerging markets face selective engagement rather than broad investment. Risk premiums rise. Capital becomes transactional rather than committed. This limits development and reinforces global divergence. The role of passive investment exacerbates concentration. Index-based allocation channels capital toward existing leaders, regardless of fundamentals. This reinforces scale advantages and reduces feedback. Leaders attract more capital because they are large. Their size then justifies further allocation. This loop intensifies inequality within markets. Corporate governance adapts to this environment. Management prioritizes capital preservation, regulatory alignment, and shareholder signaling. Long-term transformative projects lose appeal unless supported by policy or necessity. The incentive structure shifts from value creation to value defense. Innovation persists, but within narrower boundaries. Financial markets internalize these dynamics. Valuations reflect protection rather than potential. Multiples remain elevated where downside is perceived as limited. Volatility concentrates in peripheral assets. Investors misinterpret this as resilience. In reality, it reflects selective confidence and systemic bias. The distributional impact of this transition is subtle but profound. Wealth accumulates not through explosive growth, but through endurance. Those positioned early benefit from stability. Those reliant on momentum fall behind quietly. There is no collapse to force recalibration. Adjustment becomes generational. Policy responses often reinforce this outcome unintentionally. Support measures target systemically important actors to prevent disruption. This is rational from a stability perspective, but it entrenches hierarchy. Capital follows protection. Protection follows scale. The cycle reinforces itself. This explains why dissatisfaction rises even as headline indicators remain stable. The economy functions, but opportunity narrows. Participation declines. Expectations adjust downward. The system survives, but legitimacy erodes slowly. This erosion is difficult to address because it lacks a singular cause. From an investment standpoint, the lesson is clear. Broad exposure no longer guarantees participation in growth. Diversification reduces risk, but it also dilutes alignment. Success requires understanding where the system directs resources and why. Capital must follow structure, not sentiment. The mistake many make is expecting reversal. They anticipate that concentration will unwind when growth returns. This assumes a return to the old phase. There is no evidence for this. The mechanisms driving concentration are structural. They persist as long as stability is prioritized over expansion. This does not imply inevitability. Systems evolve. But evolution is slow and asymmetric. Those benefiting from the current configuration resist change. Adjustment occurs through pressure rather than reform. The path is uneven. The new phase therefore redefines success. It is no longer about maximizing exposure to growth. It is about minimizing exposure to fragility. Capital that survives gains influence over time. Capital that chases outdated narratives erodes quietly. Understanding this requires abandoning nostalgia for previous cycles. The economy is not broken. It is different. Capital is already adapted. The question is who will follow. The new rules reward those who observe incentives rather than outcomes. They punish those who mistake stability for opportunity. The phase has changed. The distribution has changed with it. Those who recognize this early will not feel lucky. They will simply feel aligned. Economic transitions are never neutral. They do not affect all participants equally, and they never distribute costs and benefits symmetrically. The new phase of the global economy is no exception. What makes it distinct is not the presence of winners and losers, but how quietly this redistribution occurs. There is no visible shock that forces recalibration. Instead, pressure is applied unevenly, slowly, and often invisible. At the center of this redistribution are households. Real purchasing power declines not through sudden collapse, but through sustained compression. Wages rise nominally, while living costs adjust faster. Housing, healthcare, education, and energy absorb a growing share of income. Consumption does not collapse, but it changes character. Discretionary spending becomes cautious. Debt substitutes income. Expectations adjust downward. This process unfolds gradually enough to avoid panic, yet persistently enough to alter behavior permanently. The middle segment of society experiences the greatest strain. It lacks the insulation of wealth and the flexibility of low fixed costs. Savings erode slowly. Asset appreciation benefits those who already own, while new entry becomes increasingly difficult. This is not the result of a single policy decision. It is the cumulative outcome of managed stability, asset support, and constrained growth. Over time, opportunity narrows without disappearing entirely. Small businesses face similar pressure. Operating margins compress as costs rise faster than pricing power. Access to credit becomes more conditional. Regulatory requirements increase. Scale advantages become decisive. Many firms survive, but fewer expand. Entrepreneurship shifts from growth-oriented ventures to subsistence operations. Innovation continues, but its economic impact diminishes. Large corporations, by contrast, adapt more easily. They possess pricing power, access to capital, and regulatory influence. They pass costs forward, restructure operations, and optimize tax and financing strategies. Their balance sheets absorb volatility that would overwhelm smaller actors. As a result, consolidation accelerates quietly. Market concentration increases not through aggressive acquisition alone, but through differential survivability. Labor markets reflect this divergence. Employment remains relatively stable, but quality fragments. High-skilled roles in protected or strategic sectors retain bargaining power. Other segments face stagnation, precarity, or automation. Workforce participation masks underlying stress. People remain employed, but with reduced mobility and weaker prospects. The appearance of resilience hides structural imbalance. Generational effects intensify these dynamics. Younger cohorts enter an economy where asset ownership is expensive and wage growth insufficient. Wealth accumulation slows. Intergenerational inequality increases. This is not cyclical disadvantage, it is structural delay. The cost of entry rises faster than income, altering lifetime trajectories. Geographically, redistribution follows similar lines. Urban centers with capital concentration, institutional presence, and policy alignment maintain momentum. Peripheral regions lag. Investment flows favor infrastructure, logistics, and control nodes rather than broad development. Regional inequality widens quietly. Political narratives lag economic reality. Internationally, the same pattern emerges. Developed economies with reserve currencies, deep markets, and institutional credibility absorb stress more effectively. Emerging economies face greater volatility, capital selectivity, and conditional engagement. Growth remains possible, but it becomes fragile and episodic. Dependency on external conditions increases. Sovereignty over economic outcomes diminishes. Public finances absorb growing pressure. Governments manage this through gradual fiscal expansion, targeted support, and narrative framing. Deficits persist without immediate consequence due to supportive monetary conditions. This postpones adjustment, but it does not eliminate it. Fiscal capacity becomes constrained by political tolerance rather than accounting limits. Policy responses attempt to balance stability and legitimacy. Support is extended selectively to prevent disruption. Broad redistribution remains limited. This is not necessarily ideological, it is structural. Systems prioritize continuity over correction. Those closest to systemic importance receive protection first. Financial markets reinforce this hierarchy. Asset price support benefits owners disproportionately. Participation becomes increasingly dependent on prior access. Passive investment channels amplify concentration. The gap between asset holders and non-holders widens without a visible trigger. The psychological impact of this redistribution is subtle. There is no singular event to mobilize resistance. Frustration accumulates quietly. Trust erodes slowly. Expectations adjust downward. This environment is stable but tense. Pressure builds without release. The absence of collapse delays response. Without crisis, reform lacks urgency. Without urgency, imbalance persists. The system functions, but dissatisfaction grows beneath the surface. This dissatisfaction expresses itself politically, socially, and culturally, rather than economically at first. For investors, understanding this redistribution is critical. Returns increasingly depend on alignment with protected structures. Exposure to broad growth becomes less effective. Defensive positioning outperforms ambition. This creates moral discomfort, but economic logic remains indifferent to sentiment. The key insight is that the new phase does not destroy wealth. It reallocates it. It does not eliminate opportunity. It concentrates it. Those expecting fairness from cycles misunderstand structure. Systems reward position, not intent. This redistribution is not the end state. It is a transitional outcome. Pressure continues to accumulate. The longer adjustment is delayed, the more uneven its resolution becomes. Stability buys time, but it also deepens divergence. The question is not whether redistribution will occur, it is whether it will remain quiet. As economic pressure accumulates unevenly, it does not remain confined to balance sheets and income statements. Over time, it migrates into politics, institutions, and social behavior. This transformation is gradual, often misunderstood, and frequently misdiagnosed. The system does not fracture where pressure originates. It fractures where pressure is felt but cannot be resolved. The first visible channel of this transformation is political volatility. When economic outcomes diverge persistently from expectations, trust in institutions erodes. Voters do not respond to macroeconomic indicators. They respond to lived experience. Stable employment with declining purchasing power does not feel like stability. It feels like stagnation. Political behavior becomes reactive, fragmented, and increasingly polarized. Governments attempt to manage this tension through targeted relief, messaging, and incremental reform. These measures reduce immediate stress, but fail to address structural imbalance. Policy becomes defensive. Long-term strategy gives way to short-term containment. Political capital is spent preserving continuity rather than enabling transition. This delays adjustment and increases future cost. Social cohesion weakens quietly. Generational divides sharpen as younger cohorts perceive limited mobility. Geographic disparities deepen as opportunity concentrates. Public discourse becomes more confrontational, not because collapse is imminent, but because progress feels inaccessible. The absence of crisis removes urgency, but the absence of progress removes patience. Financial systems absorb these tensions unevenly. Markets remain functional, but sentiment becomes brittle. Risk perception shifts abruptly in response to political signals rather than economic fundamentals. Elections, policy announcements, and regulatory changes trigger outsized reactions. Volatility migrates from economic data to political events. This reflects declining confidence in long-term frameworks. Capital responds by shortening horizons further. Investment decisions prioritize optionality over commitment. Long-term projects face skepticism unless backed by explicit guarantees. This reinforces stagnation. Growth becomes episodic, driven by intervention rather than initiative. The economy functions, but it lacks momentum. Internationally, pressure expresses itself through fragmentation rather than conflict. Trade relationships become conditional. Alliances shift pragmatically. Economic cooperation persists where necessary to maintain stability, but trust erodes. Supply chains regionalize further. Redundancy replaces efficiency. Costs rise. Productivity suffers. These outcomes are accepted as the price of control. Financial news increasingly reflects this environment. Headlines focus on resilience, avoidance, and management rather than expansion. Markets celebrate stability rather than growth. Declines are framed as orderly. Recoveries are described as fragile. Language adapts to lowered expectations. The narrative adjusts before the structure does. At a deeper level, the system begins to exhibit fatigue. Intervention remains effective, but its marginal impact declines. Each measure stabilizes outcomes temporarily while increasing dependency. Policy space narrows. Credibility becomes more valuable than capacity. When trust weakens, even powerful tools lose influence. This is where managed stability encounters its limit. Not through sudden failure, but through diminishing returns. The system can absorb shock repeatedly, but each absorption consumes political, financial, and social capital. Eventually, trade-offs become explicit. Choices that were once postponed must be made. Investors often misinterpret this stage as imminent crisis. In reality, it is prolonged transition. Adjustment accelerates not because systems break, but because tolerance declines. When enough participants conclude that waiting no longer improves outcomes, behavior changes collectively. Liquidity withdraws selectively. Risk premiums adjust. Control mechanisms are tested. The resolution of this pressure is not uniform. Some regions, sectors, and institutions adapt successfully. Others stagnate or decline. Divergence increases. This divergence fuels further tension, reinforcing the cycle. The system remains intact, but cohesion weakens. From a strategic perspective, this phase demands realism. Stability is no longer synonymous with safety. Order does not guarantee fairness. Continuity does not imply sustainability. These distinctions matter. Those who ignore them misallocate capital and expectations. The critical mistake is to assume that social and political pressure will force rapid correction. History suggests otherwise. Managed systems resist abrupt change. Adjustment occurs through accumulation rather than rupture. Pressure builds until it reshapes incentives decisively. The new phase of the global economy therefore carries an inherent contradiction. It is stable enough to persist, but strained enough to evolve. It does not collapse under weight, it bends under duration. This bending produces friction, fatigue, and eventual transformation. The outcome will not be announced in advance. It will emerge through altered behavior, redefined priorities, and changed tolerance for imbalance. By the time it is widely acknowledged, the system will already be different. This is the nature of transition without crisis. It is slower, quieter, and harder to recognize, but it is no less consequential. Those who understand this do not wait for resolution, they prepare for adaptation. Because in a managed system, the greatest risk is not instability, but assuming that stability can last indefinitely. The final phase of any economic transition is not defined by crisis, recovery, or collapse. It is defined by normalization. What was once considered temporary becomes permanent. What was once described as emergency policy becomes standard operating procedure. The global economy is now entering this stage. The question is no longer whether the system will change, but how participants adapt once change becomes the baseline. The most important feature of the new phase is permanence of management. Intervention is no longer episodic, it is continuous. Monetary policy, fiscal support, regulatory adjustment, and market oversight operate together as a standing framework rather than a reactive toolkit. This fundamentally alters incentives. Markets no longer price outcomes alone. They price behavior of authorities, tolerance thresholds, and political constraints. Economic statistics already reflect this normalization. Growth persists, but it is capped. Inflation is contained, but not eliminated. Debt levels remain elevated without triggering immediate correction. These conditions would have been unsustainable in previous eras. Today, they are maintained deliberately. Stability is preserved through constant adjustment rather than equilibrium. Central banks occupy a different role in this environment. They are no longer primarily cycle managers. They are system custodians. Their objective is continuity, not optimization. Policy decisions focus on preventing disorder rather than stimulating expansion. This explains why interventions appear smaller, slower, and more frequent. Each action is designed to adjust trajectory rather than reverse direction. Fiscal policy adapts accordingly. Governments rely on targeted spending, selective subsidies, and incremental taxation rather than sweeping reform. Budget constraints are managed politically rather than economically. Deficits persist, justified by stability imperatives. This creates a feedback loop between policy and expectation. Markets assume support, governments assume tolerance. Adjustment is postponed, not resolved. For businesses, the new phase rewards adaptability over ambition. Strategy shifts from growth maximization to risk minimization. Firms prioritize supply chain resilience, pricing power, and regulatory alignment. Capital expenditure focuses on maintenance and control rather than expansion. Innovation continues, but it is incremental and defensive. Disruption becomes expensive. Labor markets adjust unevenly. Employment remains relatively high, but wage growth remains constrained. Productivity gains concentrate in narrow sectors. Workers experience stability without advancement. This dampens consumption growth over time. The economy maintains activity, but momentum fades. This is consistent with a system designed to endure rather than accelerate. Financial markets internalize these conditions. Valuations remain elevated where protection is perceived. Risk premiums compress selectively. Volatility persists at manageable levels. Returns become uneven and episodic. Passive strategies underperform relative to aligned positioning. Capital rewards those who understand system priorities rather than macro narratives. Global trade reflects similar normalization. Supply chains regionalize further. Redundancy replaces efficiency. Costs increase, but reliability improves. Trade volumes stabilize rather than expand rapidly. This limits productivity gains, but reduces vulnerability. The world economy becomes less dynamic, but more controllable. Geopolitical considerations integrate fully into economic decision-making. Neutrality loses relevance. Alignment matters. Capital flows follow policy credibility and strategic relevance rather than pure return potential. This reshapes global investment patterns quietly. Some regions gain persistent advantage. Others face structural headwinds. The social impact of this phase is subtle but cumulative. Living standards stabilize without improving meaningfully. Inequality persists or widens slowly. Expectations adjust downward. Political systems manage dissatisfaction through narrative and incremental relief. There is no singular breaking point. Pressure diffuses across time. From an investor's perspective, preparation in this phase requires abandoning binary thinking. There is no imminent collapse to short aggressively. There is no recovery to chase blindly. The environment favors patience, selectivity, and alignment. Capital preservation matters as much as return generation. Optionality becomes the core principle. Assets that allow repositioning under changing conditions gain value. Illiquid commitments face higher scrutiny. Long-term forecasts lose relevance. Scenario planning replaces prediction. The future is managed, not forecast. The mistake many participants make is waiting for a signal that marks the end of transition. There will be no such signal. The end of transition is not an event, it is recognition. Recognition that the old phase has already concluded and that operating assumptions must change permanently. The new phase does not promise prosperity, it promises continuity. It does not eliminate risk, it redistributes it. It does not reward optimism, it rewards awareness. Those who adjust early do not appear visionary, they appear conservative until conditions justify their positioning. This is the defining feature of the current moment. The global economy has not stalled, it has recalibrated. The tools, incentives, and expectations that govern it now differ fundamentally from those of the previous era. Understanding this does not require prediction, it requires observation. The system is no longer asking participants to grow faster, it is asking them to endure longer. And those who recognize that difference will shape outcomes in the phase ahead. Preparation in the new phase is not about predicting shocks. It is about structuring behavior for an environment where outcomes are managed, incentives are asymmetric, and adjustment is prolonged. This distinction changes everything. Strategy shifts from timing events to surviving processes. Those who understand this do not search for signals of reversal. They redesign exposure to function under continuous constraint. For capital, preparation begins with redefining success. Performance is no longer measured against peak returns, but against drawdown resilience and adaptability. The objective becomes maintaining influence and optionality across scenarios, rather than maximizing gains in a single trajectory. This favors diversification across functions rather than assets. Exposure is spread across liquidity, control, duration, and alignment with system priorities. Liquidity takes on a different role. It is no longer merely defensive, it is strategic. Liquidity allows repositioning when policy changes, when regulation shifts, and when narratives break. Assets that convert easily without friction gain premium value. This does not imply abandoning risk, but it requires structuring risk so it can be exited without penalty. Illiquidity becomes an active cost, not a neutral characteristic. Duration management follows naturally. Long-term commitments require justification beyond expected return. They must offer strategic necessity, policy backing, or scarcity value. Otherwise, they impose rigidity. In a system where conditions evolve continuously, rigidity is risk. Capital prefers shorter horizons, modular investments, and layered exposure that can be adjusted incrementally. For businesses, preparation centers on flexibility rather than scale. Supply chains are redesigned for redundancy. Pricing strategies emphasize pass-through capability. Financing structures prioritize stability over leverage. Growth plans incorporate downside scenarios explicitly. This does not eliminate ambition, it disciplines it. Firms that survive the transition do not grow fastest, they fail least. Governance becomes critical. Decision-making frameworks must allow rapid adjustment without institutional paralysis. Clear authority, predefined thresholds, and scenario-based planning replace consensus-driven optimism. Organizations that prepare structurally respond faster when conditions shift. Those reliant on improvisation lag. Labor strategy also adapts. Talent retention becomes more important than expansion. Skills associated with control, compliance, data, and infrastructure gain value. Workforce stability supports operational continuity when external conditions deteriorate. This reduces volatility but constrains dynamism. Firms accept this trade-off consciously. For individual investors, preparation requires emotional recalibration. The absence of dramatic crisis can be misleading. Gradual erosion tests patience more than panic. Discipline matters more than conviction. Avoiding fragility becomes the primary goal. Exposure must reflect not only risk tolerance, but time tolerance. Waiting becomes expensive when adjustment is slow. Portfolio construction changes accordingly. Broad market exposure provides participation, but not protection. Selectivity improves outcomes. Alignment with policy priorities, essential services, and infrastructural relevance matters more than thematic enthusiasm. Returns concentrate where continuity is valued. The role of information changes as well. Headlines lag structure. Data releases reflect outcomes rather than drivers. Preparation requires observing behavior, policy sequencing, capital flows, regulatory language, and institutional positioning. These signals reveal direction before narratives adjust. One of the most difficult adjustments is accepting that fairness is not a feature of the system. Redistribution occurs through structure, not intent. Capital moves toward protection. Opportunity narrows without vanishing. Complaints do not alter incentives. Adaptation does. This does not imply cynicism. It implies realism. Systems operate according to internal logic. Understanding that logic allows participation without illusion. Those who expect correction to restore previous conditions will wait indefinitely. Those who adapt operate within reality as it exists. The final implication of the new phase is endurance. The system favors those who can sustain exposure through time rather than those who seek decisive outcomes. Change is cumulative. Advantage accrues slowly. Misalignment erodes gradually. The process is less visible, but no less decisive. This is why preparation feels unsatisfying. It lacks drama. It lacks resolution. It requires patience without reward in the short term. But it is precisely this discipline that preserves relevance when transition completes. Eventually, the system will stabilize into a new equilibrium. That equilibrium will not resemble the past. It will reflect the choices made during transition. Capital, businesses, and individuals positioned early will shape it. Others will adapt later at higher cost. The global economy is not approaching an end. It is completing a shift. The most important decisions are not being made during crisis. They are being made quietly, in advance. Those who understand the phase do not rush. They align. Because in a managed system, survival is not accidental. It is designed. And design favors those who prepare before necessity demands it. The phase has changed, so must the strategy. Those who recognize this do not wait for permission. They move within reality as it is, not as it was. The new phase will not reward optimism. It will not forgive delay, and it will not announce its turning points. Capital will move where protection exists. Opportunity will concentrate where control is strongest. And those waiting for the old cycle to return will wait forever. This is not a warning. It is a reality check. The global economy has changed its logic. Those who adapt will remain relevant. Those who do not will fall behind quietly. Understand the phase. Adjust the strategy.